And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. How will the Fed's hawkish stance on tapering and potential rate hikes affect the market in 2022? Let's find out what the CEO of one of the world's largest private investment firms is telling his clients. Gerard O'Reilly is co-CEO of Dimensional Fund Advisors, one of the largest value managers in the world and a leader in converting mutual funds into ETFs. Also joining us is Nate Geraci, president of the ETF store. Gerard, the reappointment of Jay Powell has the markets operating under the assumption that future Fed policy will now tilt towards a more hawkish stance. What, in your opinion, does this mean for stocks in 2022, and what does raising rates mean for the markets right now?
So thanks, Bob, and thanks for having me on the show. It's good to see you. You know, when you look at what the Fed is doing today, they're really telegraphing what their plans are over the next few months. And so the market is incorporating that information into prices today. So what we tell our clients is, well, let's look to the long term to see how markets have incorporated this type of information in the past. And when you look back over the past 40 years, Bob, the average monthly return on the US market has been about 1% a month. And when you look at it in months when the Fed has raised the target Fed funds rate or decreased the target Fed funds rate, it has been about 1% a month. And regardless of what the Fed has done, about 2/3 of the time, the market has gone up in months whether it's raised or decreased the target Fed funds rate. So the Fed is telling the market what it's planning to do. The market already has priced that in. So if the Fed does what the market expects, you can expect the long pull return on markets, in my view. And that's effectively what we're telling our clients. Focus on the long term, look at the long-term data.
Yeah, that's what you guys are all about. Now, Gerard, I want you to reiterate your investment philosophy. I always ask you to do this when you're on. You're very closely aligned with index investing, but you layer over that a small cap and a value tilt. Can you explain that and what the ideology and the methodology is?
Yes, indeed, Bob. We are closely aligned with index investing. But how I like to describe ourselves is that we're systematic fundamental. And what does that mean? Well, it's not something new. That's the good news. We've been doing this for 40 years. But what it means is it takes a lot of the benefits of indexing, whether that's low cost, whether that's transparent, rules-based approach. And what it layers on top of that is a daily process, daily oversight. And that daily oversight allows us to take information from stock prices, from bond prices, to increase expected returns and manage risk, in my view, more robustly than an index approach does. So you can think about it as all the benefits of indexing, but then take that active implementation and try to add value in excess of indexing. And you're right, Bob, we do tilt to small cap and value stocks, as well as high profitability stocks. And what we're pursuing there are higher returns on behalf of our clients, because over the long pull, what we've seen is small cap value and high profitability stocks have outpaced the market by about 2 to 3 to 4 percentage points a year. So we're pursuing those higher returns on behalf of our investors.
I want to come back to that higher profitability shortly, but let me just follow up, Gerard. Small cap and small cap value have done well this year, but it's really the first outperformance in several years. So we've got this uncertainty over the Omicron variant. But what's the outlook for small cap and value in 2022? Are you basically just still stay the course? Do you think small cap and small cap value can outperform growth and big cap in 2022?
We do indeed, Bob, because when you think about the Omicron variant and you think about new news when it comes to the marketplace, it moves stocks. After it has moved stocks, people may still talk about it, but now it's old news. And so market prices are forward-looking, their predictions of the future. And again, what's known about the Omicron variant is known and already priced into stocks. So again, we look to the long pull. And over the long pull, even after years when small value has outperformed large growth, and we see this in the data, the following 12 months tend to be pretty good for small and value. You get a little bit higher than the long pull average. And that long pull average, by the way, Bob, has been about 4% or so per year for small value in excess of large growth, maybe even higher in some years. So again, we tell our clients, invest for the long term and look to the long term to inform their expectations on any given year. So we think small and value stocks are well poised to outpace the market for 2022.
You know, Nate, despite what Gerard is saying, investors, at least CNBC viewers, seem pretty obsessed with growth and have been for the last decade, really, since the Fed has been stimulating the economy. But investors are paying an awful lot of money for growth these days, for a future stream of earnings, at least for a dollar's worth. Is that going to change in 2022? Do you think, as Gerard thinks, that small cap or value may outperform?
Yeah, I don't think there's any question the overall backdrop here is growth is richly valued at this point. And especially as you start to go down the quality spectrum, look at areas like unprofitable technology companies, they're clearly overvalued at this point, and we're seeing the ramifications of that here recently in the market. I want to echo what Gerard is saying, and that certainly taking a long-term approach here is prudent, but there's a lot of confusion in the marketplace right now, and that the Omicron variant, that could have a meaningful impact on the economy if things are worse than expected. But at the same time, we have a Fed who is taking a more hawkish posture at this point in time, indicating that inflation may not be transitory. And perhaps they may look at tapering bond purchases sooner than expected and raising rates sooner than expected. In my opinion, those two things are at odds with each other, because if the variant is more of an issue than expected, clearly the Fed can't be overly aggressive in that situation. Now, you could have a unique situation where perhaps the variant is more of an issue and it does have some economic impact, but that ultimately leads to supply chain constraints. And you start seeing greater inflationary pressure even while the economy isn't doing so well. That would be a very tricky spot for the Fed to be in my opinion, probably a worst case scenario.
So that's the problem, Nate. I mean, most viewers I talked to wrote into me, said they assumed Omicron would make the Fed more dovish, but it's turning out Omicron is making the Fed more hawkish because they're even more concerned about potential inflation because the supply chain disruptions might continue under Omicron. That's what's causing all this confusion out here. That's why people can't figure out why is the 10-year yield so low if we're going to have problems down the road. It just creates a lot of confusion. At least the viewers are totally confused right now, Nate.
No, there's no question. Now, I will say we can look at what the Fed has done over the past decade plus. Clearly, they've been supportive of the financial markets. And when you think of the one instance when they attempted to get more aggressive back in the fourth quarter of 2018, the market clearly reacted negatively and the Fed quickly reversed course. And so I think investors have this feeling that the Fed is always going to be supportive of the market. And until we see something different, I think that's probably a pretty good bet.